Hello, my name is Aaron Edwards, co-founder and market consultant of Santos Springs. We offer grain marketing solutions to producers in multiple countries. Welcome to our W2H grain marketing channel. Go ahead and hit the subscribe button. I also recommend tapping the bell so you get future notifications. And if you like what you see, hit the like and share this video with other farmers who care deeply about their grain marketing. If you are a corn or soybean farmer, your revenue depends not only on your production, but also the answer to three simple questions: when, how much, and how you sell. One W, when, two H's, how and how much. Our W2H mentorship provides a clear, concise, and custom approach to answering each one of these three questions for your specific farm throughout the year. Before we start this week's content, it's always important to remember that trading in futures products entails significant risk of loss, which must be understood prior to trading and may not be appropriate for all investors. This commentary and the information contained within should be considered market commentary and reflect the opinions of the author. For those of you watching this with a delay, if you are a U.S. corn or soybean farmer and want to stop being held hostage by market uncertainty, let us teach you how to place each one of your bushels in a grain marketing strategy specifically designed to optimize your farm's revenue. Click on the link and we'll work together to see if our W2H mentorship is the right next step for your grain marketing. My name is Aaron Edwards with Santos Springs. It is September 16th, 2025. We have a market that is not horrible. It's not really good, but it's not horrible. We're going to talk about recommendations first, and then we're going to talk about corn and soybean markets and really how bullish can we be in this environment? That's the underlying question. So there's a lot of good stuff. I encourage you to watch the video to the end, but let's start with the recommendations. I believe this is the first time ever that I have given an optional recommendation, and I'll explain why. Let me check that box. Optional long positions on corn. Reach out if you have any questions. The official recommendation, so to speak, is we have some unfinished business on Q3 corn and new crop corn, but they're on basis contracts. So I don't want to price those basis contracts long, and essentially we are long the corn market via those basis contracts. So that's kind of the official recommendation. Why the optional recommendations? I've talked to a few of you, and it turns out there's a lot of corn out there. We're just getting ready to harvest. So I'm guessing on many of your farms, there's kind of bushels without a home, so to speak. What should I do with overrun bushels in corn? So I kind of want to walk through a thought process. And this is also the passing of the baton. As you know, we do recommendations basically on when to move our grain quarterly. So we're almost to start Q4. And not only will we be starting Q4, it's also the passing of the baton between old crop and new crop. So we're going to be wrapping up our 24-25 marketing year here at the end of September, and then we'll be starting our 25-26 marketing year. So we're going to kind of pass that baton, and just kind of in the shoring up of those, there might be some overrun corn bushels, and it might make sense on your operation to sell some of those and take on a long position or adjust that one way or another. For some of you, there might be alternatives better than just tucking it away, paying custom storage, and waiting. So I wanted to walk through the thought process of kind of what are your options on the corn, because for some of you it might make sense or almost be necessary to make some type of adjustment. So as we look here at if we're going to fill out the boxes. So strategy number one is just say, the heck with it, I'm selling the corn. Administratively, that's a low demand. I mean, you just sell the corn. There's nothing administratively. That's good for cash. It gives you a good cash position because you sell the corn, you get cash. Not talking about price, not talking about profitability. I'm just talking about your cash position. And basically no more exposure, right? For good or for bad, there's no more exposure because you sold it. Option number two is you pay custom storage. I'm just saying you pay whatever it takes to get you to the end of the year. A lot of grain elevators have a deal. Hey, it gets you to, the end of December, the end of January, you pay a lump sum, and then after that it's month by month. Some of you go straight to month by month. There's different ways to do that, but let's just, for the sake of the example, you're going to pay custom storage till the end of the year. Let's just use that example. So admin, it's not zero because you have to make a decision, but it's also low. You have, you have to tuck it away, probably write a contract to store the grain, and then, or sign a contract and then show up later and sell it. But it's low, not much to do there. It doesn't give you cash. It doesn't give you cash until you sell it. For some of you, that's an issue. For some of you, that's not an issue. Exposure, I'm going to write full exposure, whether the price goes up or down. It's actually technically not absolutely full exposure to the board of trade price, because your local elevator can improve, it can improve or lessen your basis. But I'm going to put full exposure because you still have the grain. And it is, anyhow, full exposure. Then we're going to put the admin here of another strategy would be to sell it and then to buy calls. Especially like back in the 80s when interest rates were astronomically high. That was a very popular strategy for a number of reasons. But a lot of people have done that for years, and there's a reason to it, but let's look through it. Admin, basically you need some. It's not bad. You need to have a hedge account, and you need to be able to place an order to buy calls, right? I'm guessing most of you do that throughout a broker. Some of you that I know don't have hedge accounts, I actually emailed you last week if you're looking for help with that. It's not a service I provide, but I can refer people if you need help with that. If you're already set up, that's fine. There's some admin. It's good for cash. It's not your full cash position because you'll sell it, then you'll need to take part of that cash to buy some calls, but you get to keep most of your money. And it's limited exposure to markets, which can be good or bad, right? As it rallies up, ultimately you want the gain to be, you want the rally to be bigger than your premium invested. It's a little more complex than that, but limited exposure, which could be good or bad. Admin, there is some admin. The next strategy would be you sell and buy futures. There's some admin. It's good for cash because you get to keep most of your cash. You need to keep a little bit of liquidity in case you have to make some margin calls, but you get to keep most of your cash, and it's pretty close to full exposure. As you think about what you're looking for, the one thing I would encourage you to be cautious about is, I feel like saying, oh, I don't like the administrative hassle. I think that we're at a point where that's a luxury that's kind of expensive. I would like for you to have full access to whatever tools you need to have. So basically, it's a nice way of saying, I think it's wise in this day and age with everything going on, and as hard as the farm economy is, I think it's wise for you to have a hedge account, whether you use it a lot or a little. Exactly. I would not, this admin, I would not let that be a hurdle. Most of the strategies can improve your cash position if you need cash. And then you kind of have to choose your exposure, how much exposure you want to price. So on that note, talking about exposure, I'll stop sharing this screen. We'll move to the next one. And let's do a little bit of analysis on this. There's actually, it's not a ton of images, but there's some talking points today that I think are fascinating. Kind of excited to go over it. Okay, so let's go over some of these talking points. First thing, let me grab a marker. I'm gonna make this, we'll do the first one yellow. Okay. This is the Brazil-USA exchange rate. So basically, if this says 620, that means it takes well, they use commas down there, but let me do it here. Give me grief, there we go. 6.2 of the Brazilian currency for $1 US. Okay, that's what that 6.2 means. What you need, I don't want to get overly complex on this, but what you need to remember is if this is high, then BR grain is cheap. Their currency isn't worth much. Their grain is cheap. What we have right now is kind of the other extreme. Let me get that in red down here. Red. We're way down here. That's where we are right now. Which what this means is USA grain is cheap. That's not exactly the best way to think about it from a standpoint of like, technically speaking, is our grain cheaper? Are we more competitive? But what I wanted to point out about the exchange rate is this. Brazilian farmers' exchange rate is so low that they don't have prices that they're excited about to sell to add selling pressure. I just want you to tuck that information away for two reasons. We're going to talk about corn, and then we're going to talk about soybeans. So on corn, what that means is the U.S. corn, it can be competitive at the global market, even at a little bit higher price than in the past, because the exchange rate is lower. So they need more Brazilian currency. So I'm making it more confusing than it should be. This allows us, this low exchange rate, as we compete with Brazil for export business on corn, it allows us to charge a little bit more and still be competitive. That's the good news from corn. On soybeans, it's a little different because they're almost out of old crop soybeans, so we're kind of looking at next year's. So what I think is probably going to happen is, if this exchange rate stays low, either Chicago needs to go up or their basis needs to go up in order to encourage farmers selling out of South America. And so if we're below a cost of production here in the US, but they're selling the heck out of the soybean market in Brazil, that's tough. If we're below the cost of production here in the US, but they're not motivated sellers down there, we might see a price that ratchets up to something where you would start drawing in US selling pressure. Now let's talk a little bit about those markets specifically, the corn and the soybean market. So the philosophy we want, based on a portfolio, it's unique to each operation. We look at seasonals, funds, technicals, that helps us have that call to action. And then we have that action plan. So let's start briefly talking about the position of the funds. There's not a ton to go over on corn. We've seen corn gradually reduce their their net short positions, and then last week they sold a little bit more corn. So it's kind of just leave that on the back burner. But speculators are like, maybe I do want to be short corn. And then now let's look at the actual corn position. I want to get blue for this, because the good news is we are in an uptrend, and this corn market is actually trading surprisingly strong. If this trend continues, what we would expect would be something like we stay in an uptrend until we get somewhere into this wedge, and then either we're going to get that golden cross and it's going to keep going up, or it'll fail, and then basically we would have this blue line turn a corner, or we want that in blue. Blue would turn a corner, and then we would see this corn come back down. All right, if it stays in an uptrend. If this is a head fake, if this is all we get, support would be way down in here. Well, the first support would be here, and then the second support would be at these lows, is kind of what we would look at, which would be under $4. This is December corn. That's a little bit disheartening. So if we want to be, in a nutshell, if we want to be super optimistic, corn is going to stay above this 20-day moving average, and it's just we're going to go to the moon. That's the super optimistic. The super pessimistic would be speculators are going to sell this thing, party's over, we're going back down to these lows sometime late September, early October. We'll be testing out those August lows, and that's about as good as we're going to get. What's the most probable, in my opinion? Nobody has a crystal ball. In my opinion, what's the most probable on this corn market is there's going to be some combination. I'll even do this in yellow, where this 20-day kind of slowly works its way up, and we mainly just stay sideways. Goes up a little bit, down a little bit, and then sometime in October, maybe it either sells off or rallies. But We're struggling to rally very fast, but we absolutely aren't falling. That's a pretty strong line up. So it's not going to the moon. And then you say, well, should I buy or should I not buy? With some degree of confidence, I think in the next month or two, we will probably be, if you just look at support and resistance right now, support here would be the 416 mark. Resistance would be 440. We're trading 428. We're kind of right in the middle of that. So if you're looking to buy, and if you can get anything, I would say in this between say 418 and 428, or closer to 420, if you could buy in closer to 420, I think there's a decent shot that you can run it up 15 to 20 cents over the next month or two. If you're looking to buy. And then maybe calls would work, but the thing is, if you're going to get a 10 or 15 cent rally and you're going to spend 10 or 15 cents on a call, will it work? Maybe, but how much will it work? The risk is that the frustrating part is that we're kind of right in this no man's land right here. It would be a lot easier to encourage buying if we were sitting like right in here and say, oh man, I bet we're going to stay in an uptrend. That would be easier to encourage buying. Or if we were down here at this support, but we're not super optimistic because we have this big 440 ceiling on us, which is coming down every day we trade under it. And it's just kind of one of those, it might be the right thing on your farm or on your operation, but it's kind of one of those tough decisions on whether you should step into this market or not. We've gone up too much to be excited about buying, but there's not a ton of potential, so it's not super exciting on that front. And then now let's talk a little bit about soybeans. Let's go to the soybean market. So as we look at soybeans, let me get I think a yellow. Let's do blue here. Let's see. Let's see yellow. Okay. So soybeans, they're net short. Last week and 2 weeks ago, they were net long. Before that, they were short for several weeks. And then before that, they were long. And before that, they were short. And then they were long. And then they were short. And then you really have to go way back to get these significant oversold positions. For really the last 12 months, soybeans have just been either a little bit long or a little bit short, a little bit long or a little bit short. I mean, it's really kind of boring. And when we look at the soybean market, it's really pretty boring. So you can get a black marker on this. Well, let's do it a little bit differently. Okay, let's say red is sell. And let's say that green is buy. So I want you to think about it this way. Over the last 12 months, if you were to look, okay, anything basically under $10, this is the $10 mark. Anything under $10 would have been a buy. And anything, I'm going to write 1060, which is a pretty tight range, but let's just go 1060. Anything over 1060, this is November beans, would have been a sell. Let me even see if I can do that a little bit better. Just do the same thing. This is just the range of prices, all right? But I want to show this in kind of a different way. I want to look at this in kind of a different way. If we think of spring planting and the seasonality of that, let me draw a box, basically May, June, and July, right? So let's draw a box here where we look at May, June, and July. July would be here. I went down maybe a little too much, but let's see if it's gonna square that. Okay. Think about that as our selling season. All right, the selling season. So if you recall, I recommended fairly aggressive soybean sales here in June. Why? Because it was at the upper end of the range and at the tail end of the selling season. That's a fairly obvious sell. Does that make sense? But now let's look at the buying season. Let's look at the buying season. All right, we are here in September. September, it's time to buy. And really, if we think of, let's just do September and October as the buying season. So October and September, let me get that in green. These markets could go up because it's the buying season. I guess I came down to August, but it's just to give you the visual. And then now all of a sudden, should I be selling or should I not be selling? Well, over here we have, yes, on one hand, we're at the upper end of this range, but on the other side, we're at the upper end of the range during a buying season. So because we've been range-bound trade, beans never came down all the way here. I'll do a little star there. And they might not go up here. And it is the buying season, so maybe beans will come right back down. But the truth of the matter is, we are at the upper end of the range in the buying season. And then the question is, can it go up? Can we see beans make this type of move, get up over $11? Can we finally see a decent rally in soybeans? And here's what I'd like to point out on that front. So a couple of things. Number one, the exchange rate that I mentioned. Farmers in Brazil, if the exchange rate is low, they are not very motivated to sell because they're not getting very much Brazilian currency for their soybeans. So are you going to forward price at the worst exchange rate in a year? It's not very tempting for them to do that. That's the first thing. The second thing is, if you look at China buying, there was a period of about 2 to 3 months right at the beginning of the year where they don't have enough bookings available. So China needs soybeans right at the beginning of the year. And what they would love to do is to just buy that straight out of Brazil. Brazil still has some old crop beans, and if they get planting done on time, that you can start getting some soybeans harvested in January. You load those first soybeans onto a ship, you send them to China, and all of a sudden, maybe it's a little tight, but they can basically just buy from the US, from Brazil. But if that planting is delayed, even just a little bit in Brazil, there might be 2 to 3 months where China they can't get their supply from Brazil. This isn't a quantity issue, it's a timing issue, okay? Brazil has exported a lot of soybeans. They don't have that many soybeans in the country anymore. And if planting is even just slightly delayed in Brazil, China might need to buy soybeans. And then there's the whole possibility of a trade deal working out. And that might not seem like a big deal, but think about the total purchases from China, not exports from the US to China, total purchases of soybeans from China. And then all you say, oh, but it's just a month or two. Okay, but if you bump that up to 3, if there's delayed planting and we need to cover here in the US, we need to cover 25% of soybeans demand out of China, and then you give them a low exchange rate, and farmers in the US are willing sellers at a price that I think it's possible that a deal gets done either because China actually needs the beans or because trade negotiations worked. Either way, we have the possibility of an actual significant window of opportunity where China may need US soybeans. may need US soybeans, all right? So the question at the beginning of the video is, how bullish can we be? And here's my 2 cents on that. Combines are starting to roll in the USA, or they already are rolling. We are at the upper end of the range. A lot of farmers are struggling to show profitability on soybeans here in the US. We are competitive from an exchange rate standpoint. We are more competitive than we have been in the last 12 months from an exchange rate standpoint. And China may need soybeans from us, even if it's just to fill in a blank for 1 to 2 months, December, January, February, but they may need our soybeans. And anytime that you need to come negotiate with the US for grain, the US has the ability to basically say, okay, you're going to pay me what I need. US is almost the only country that does that effectively when it comes to grain sales. But decent rallies happen when you actually need to do business with the US. So I'm not overly bullish. All of these things are a little bit like, they're kind of weak. It's not necessary, right? Maybe planting gets off to a good rate in Brazil and China doesn't need to come to the table. Maybe there will be a lot of farmers selling out of the US right off the combine, and that'll take care of any demand we have. Maybe that exchange rate a week from now will be a totally different story. All of these things could go away pretty quick. But for me, we're at the upper end of the range. We have a bullish headlines that are, kind of 2 tiers deep, so to speak. It's at least worth waiting to see if there's going to be delayed planting. It's at least worth, it's not irresponsible to be somewhat bullish soybeans now, in my opinion. That's the simplest way to put it. And the truth of the matter is, I kind of feel the same way about corn, right? If this exchange rate story continues, I think corn will be limited. I don't think we'll get a real strong rally in corn, but generally speaking, it's good news. All right, now let's go to just the summary. Let's just wrap it up. We've talked a lot. I've talked a lot, I should say. All right, seasonally, for corn, it is a buy. For soybeans, it is a buy. Managed money is short on corn and short on soybeans, but in neither case are they short enough to justify buying. And the trend is up for corn, and the trend is up for beans. Basis levels in the US are low, as is common for harvest. Soybeans are trading at the upper end of the price range they have negotiated at over the last year. What is hopeful is that they are trading at these high prices right at harvest. Corn is above the 20-day moving average. But below the 200-day moving average. I think the most probable scenario for corn over the next few weeks is that it will trade sideways into this wedge, staying above the 20-day moving average and below the 200-day moving average. So what that would mean just on corn, because I think a lot of people maybe have questions. 20-day moving average on December corn, for example, it was 416. The 200 was at 440. So every day that goes by, that 416 will come up, and it'll come up kind of fast. That 440 will come down, but it'll come down pretty slowly, maybe like a penny a day or a half a penny a day, because there's 200. the price change divided by 200. It doesn't change that fast. Price change divided by 20 bumps it up pretty quick. The average changes faster, right? So to the extent that that's true, we're probably looking at corn somewhere, basically corn's going to trade in the 420s for quite a while and then into the 430s, and right now it's at 428. So basically sideways, right? Goes down a nickel, goes up a nickel, goes down maybe a dime, and then goes up 8 cents, and then goes up another 5 cents. It's just kind of this boring trade, getting into that wedge, and then it'll break out one way or another. We might get a rally like we did last year, or the market might lose its support and really trade pressure down. But all the same, hope you have a great week. I know some of you are starting on harvest. Be safe. Hope the work goes well in the field. And feel free to send me pictures. I love seeing pictures of how harvest is going. Take care.